Dan, good morning. I think I'm like an old broken record. In fact, for our younger audience, a broken streaming service, Spotify or something, because I'm making the same point I've made many times over the last week or so. Not every market has gone gangbusters to the upside with some degree of irrationality. Not every market is Chesapeake or Hertz or the FANGs or what have you, or strange stocks that Jeff's talking about where people are getting the wrong acronym as well. Many indices and many measures of the market are trading in bear market. For instance, the energy market. Many are trading in corrections, such as real estate, such as industrials as well. Why do we keep being lazy with the truth with our viewers and saying everything's gone north to the races when we know there are a large tranche of the market that haven't got anywhere near their record levels?
Well, I agree that they haven't gone near their record levels in absolute terms. But even if you look, for example, it's a great example, energy. If you look at energy, the multiple expansion has been phenomenal in the last 2 weeks. Actually, because if you look at the pace of downward revisions of earnings in energy, they've been way larger than the slump that they had in the market in the previous months. And also we have to remember that many of the sectors that do remain in bear market territory were sectors that already in a bull market, 2019, were those that are called value traps, the ones that were delivering very poor returns below cost of capital, even losses.
But I mean, you look at the energy price, and we've seen the oil price rally very aggressively from its April lows, but it's still trading below the cost per barrel of many, if not most, IOCs. They're trying to get it down to $40 to $35, but a lot of them are still trading at a break-even level of around about $55, $60 in some cases as well. So the energy price is telling us that there is much more pain to come in that broader sector. That's quite a reliable measure. I know we're talking $40. Oh my goodness, it's come from a big way from its lows, but actually it's come even further from the highs.
Absolutely. I think that is the critical factor in precisely because in this rally, which has been led by the value stocks, that usually are believed to start to price in a rapid recovery. If you look at what both the earnings and the underlying commodity price, not just oil, which is, you're absolutely correct, but also natural gas, refining margins, marketing margins for IOCs, for big oil, what we are seeing right now is actually not just a downgrade because of the low oil price, but downgrades because weak volumes, weak margins, and a weakening environment as well for their cost base. So I think that if you look at the energy sector in general, there's still a lot of pain to go. I agree that with low interest rates and with massive liquidity, markets decide to look at the ones that are highly geared or that have a lot of pain based on their debt structure. But it is a very dangerous trade. And we have seen this before. We've seen it in 2015, 16, and also in 2018, when the energy sector was always sort of leading at the beginning of a credit bubble and then quickly faded away as the reality of overcapacity and poor margins kicked in.